Okay folks, welcome to this week's index review. My name is Mark Austin from Magnetic Trading, and we're going to talk you through one of our high probability trades that we took last week on the FTSE. It's actually based on expiry, so this is when options and futures expire at the same time. And it has a 90% success rate. So I'm going to show you why and how we managed that trade on Friday. We're also going to give you a trade tip of the week. So let's go into the charts and show you what's been happening. Okay, as mentioned, we're looking at a FTSE 100 chart here. This is the UK index, and specifically we're looking at 10 past 10 price on Friday. We knew that we needed to trade at this specific time on Friday. In fact, every Friday of every month, it has to be the third Friday of every month, there is an expiry that happens. It lasts for 5 minutes between 10 past 10 to 10:15 a.m. on the FTSE every third Friday. It's when options expire. And every quarterly month, you get options and future contracts expire. Also, that lasts 5 minutes. What's an option on a futures contract? If you don't know, you can Google that, but basically it's an instrument whereby you can take a view of where price is likely to be in the future. So do you think the price is going to be lower or higher? And you can do it on all sorts of instruments, and markets. You can do it. We did it on oil recently, actually. If you remember, oil plummeted as a result of COVID, and we took a view that we wanted to take a July contract when the price was 23 bucks a barrel. We viewed that the price in July would be higher than 23, just because it was exaggerated to the downside. There was fear and panic driving oil prices to a level which really wasn't sustainable. People are going to be using their cars. They're going to get back into their normal lifestyles, and oil demand will go up, which is exactly what's happened, and oil has rocketed since then. So we've done quite well out of that. But you can take a contract on anything really out there. You can take it on soybeans, you can take it on oil, gold, but you can also take it out on the index markets as well. And as I said, you can do it on the FTSE 100, and we know that at 10 past 10 there's going to be some sort of price spike. So what we do is we wait for the market to spike a certain distance, and then we look to trade it back to the open price at 10 past 10. So this is a 1 minute chart here, and we can see that the open price at 10 past 10 was 62.75. Okay. So what we did with our clients, and of course if you're taking the advisor trial, you would have been in the live room with us and traded this live with us. But basically we were looking for a 20-point move to the upside to sell. So we wouldn't sell unless we saw that. And so 20 points higher is 95 here. And we were also going to add to the trade if it went a further 20 points as well. So had it gone up to 315 during those 5 minutes, 63.15, we would have also sold again. But in this case, usually it gets a bigger move for triple witching. But in this case, it was just over 20 points of move we saw on this one. It got to a high of 63.01 during that 5 minute period. So each 1 minute candlestick here is 1 minute of action. So 1, 2, 3, 4, 5. This is the end of expiry. So when this 1 minute bar candlestick closes at 10:14, that of course is 5 minutes of action. So what we then expect is we expect the price to retrace back to the open price at 62.75. Now we chose a stop for this at 63.26. That's what we told our clients to use as a stop. Again, the levels at which the spike and the stop are determined is based on our own proprietary system. So we know in advance what is the level amount of spike we're expecting, and also where to place our stop. So we're in this trade here, we have our stop up here, and then really it's just a case of waiting it out, and it can take some time. So we place our target right here at 62.75, and we put our stop, and really we can walk away then. And as you'll see, it just actually consolidated for some time. We took a little bit of heat out. It actually got above 63.21 before retreating, and then it basically came down. Now you'll notice actually it came back down to our entry. Now at this point in time, I was actually looking to we actually told our clients to come out at entry. The reason being is that America was going to open, so that reduces the edge of the trade. Even though it's got a 90% success rate, and I really thought it was going to do it, I would have been very disappointed had America rallied and pushed this market up and taken our stop at 63.26. So in this case, risk management had to be deployed, and we came out of the trade at entry. And of course, lo and behold, it went back down and filled that market inefficiency and went back down to 62.75 later on in the trading session. But as I said, it was after the FTSE closed, but it did close that market inefficiency later on. So it's a really high probability trade. We trade it every month. Hopefully you can be part of an advisor and join us on this specific trade. We also do it on other markets like your local ASX market.